Hey there, Jay. Can you hear me?
Yes. Hey, Matt.
How's it going, Jay?
Good. How are you?
Yeah, it's
Are we
good.
good?
I'm looking forward to picking your brain on the current Bitcoin price cycle and just your thoughts, given your background in Wall Street and building exchanges. I think this will be a really interesting conversation from my point of view. In your recent video, you talked about the Bitcoin price cycle and the halving cycle. Maybe you can go into what the differences are and just start from there, if that's okay.
Sure. Yeah, Matt. Thanks for doing this. I've seen you online the past couple of years, and it's glad that we're connecting and starting to work together. I've been on Wall Street financial markets for 10 years before Bitcoin started. I've been doing mostly software development in the space, but also trading. I've been around the block, put it that way. I always thought there was price cycles, right? Prices move in cycles for various reasons. There's a bull cycle, there's bear cycles. They average sometimes 3 to 4 years. Back in the day, Bitcoin was not necessarily correlated to other risk assets. That seems like recently it has been. There's this concept in markets of discounting known information, right? Price reflects the current view of all known information and also unknown information as it becomes known. The halvings have been known from day one, so it doesn't maybe have coincided with price cycles. But I think that was a mistake to say that the halving cycle predicts price cycles. It may have just been a correlation, not a causation. So I think price cycles are more important than the halving cycle. That's my thesis, and that's what I tried to discuss in that last tweet.
Okay, so if that's true, your thesis, then where do you think we are right now? Do you think we're in a bull run, a bear market? What's your opinions on that?
Yeah, so it looks like we came from the lows of about 15,000 after the TX debacle and all that stuff that happened about a year ago, right? It was like one shoe after the other, and it was a pretty massive decline. And we came up a lot since then. I wasn't expecting the run so high, but once we doubled, it was obvious that we're going up. The cycle's not confirmed until you break the highs. Bitcoin did touch the new highs, didn't go any further than that. We start looking at the broader market, which Bitcoin didn't have to look at because there really was no broader market. But now with Ethereum, with other assets in the space that are correlated to Bitcoin, most of their move is Bitcoin. If you look at the broader market, it hasn't touched the highs, and now it's coming back from those highs. So it looks like unless we could sustain a move above 74,000, there's a chance that this was a massive bear market rally, and we're still in that previous cycle. If that's the case, then we should see a bottom in the 30s coming up here towards the end of the year, and we continue sideways until we find some new buying pressure, whether it's interest rates go to zero or something happens on that front. So that's the current thesis, which is why I predicted a flat summer. As the months go by, there's more selling pressure coming in, and we just need that stimulus to get the price back up.
So we just need more money printing, and we'll be back in a bull, basically. Is that what you're saying?
That's how it works, right? Some sort of disaster, some sort of money printing, stimulate the economy, liquidity in the system. Yeah. So, yeah, the money will come to Bitcoin first, like it did in COVID.
Do you think it's concerning at all, like Bitcoin being a decentralized, out-of-the-system asset being correlated with big tech stocks? Do you think that's a concern, or would that be priced out eventually in the future?
In the first 5 years, Bitcoin was not correlated at all. It was uncorrelated to the stock market, and it was outperforming it. Even the cycles were not correlated. It was a great way to de-risk your other investments, but Wall Street wasn't there yet. Recently, since the ETFs, as there was less use of Bitcoin on chain, usage started dropping, and it became more of a speculative asset, more typical fintech and finance people started adding it to the portfolio, speculating on it. And now it seems to be the correlation to global liquidity risk. And I think it's going to take innovation in the Bitcoin space, and that's a can of worms. But it's going to take something to actually break it, to break the correlation. The only question is, if there's a run to gold during some massive depression or event, can Bitcoin at least correlate to safety? We really haven't seen that yet. We saw a little bit of that, but not much. It's actually the opposite. Bitcoin gets sold out first, which makes sense. As speculative portfolio, you want to, when things are going bad, you want to sell the most liquid assets. Bitcoin is special, and it's like gold, but it's also liquid. It's electronic. It's easy.
We did see a year or two ago when there was that small banking crisis of the small retail banks. We did see Bitcoin have a big pump after those started collapsing. So there is, some sign that it's its own asset, and it's like a hedge against the risk of bank failures in some way. Do you agree?
Yeah, I did notice it a couple of times here and there. It could be during the 1929 depression. Gold, I don't know exactly, but I know it swung like massive sell-off and then massive rebound. That's a liquidity thing. It could be that eventually it will be a flight to safety. But as of right now, if there's a risk-off event, Bitcoin, especially with all the ETF money, you get the ETF flows in and it gets the price up. But then on the other hand, you have a bunch of regular portfolios with Bitcoin, and when they get margin calls, they're going to sell their ETFs. So it seems like we're more and more intertwined with risk events. People are just going to sell all, and we'll see what happens as interest rates drop and the market drops with it. Then we could see hopefully a quick drop and a rally. Bitcoin usually happens really fast. I'm not saying I'm bearish. I'll be bullish at 74,000. Right? You miss 15,000. It's not a big deal.
So 74K is like the bullish confirmation for you then, that we're in a bull market again. That's like
we need to sustain above it. Look at all the other bull markets. You fly right past the highs. You don't just stick around there.
When we were at 19K and then just flew right above it in like 2020.
All the speculative stuff is outperforms, right, because of the beta. So you would have to see Ethereum making all-time highs. That would also confirm.
But I've also heard you say that you see Bitcoin going to $1 million in the future. How do you see that coming about, and why would that be?
8 years ago, it was like, okay, Bitcoin $1 million, right? It was at like $20, and it was like, okay, how does it get there? Let's say Bitcoin is going to $1 million, right? How does it get there? It gets there with massive moves and then 80% drops. It's the only way to go from zero to $1 million. It's going to get there with people buying and speculating, and then when the first crop of people stop buying, it starts dropping. People that are screaming for a new bull run and excited about 100,000, what do you expect them to do when they get there? They're probably going to sell or use it. That's what happens. Once people do make, we've gone from 1 to 100, from 100 to 1,000 to 10,000, right? So each time it's a huge move, and the people that got it, they usually use it to better their lives and sell a little bit, and then waiting for the next round, and that's how it happens. As far as $1 million go, to me, what's the difference between $10,000 and $1 million, right? At $1, $10,000 was $1 million, right? Yeah. So now we have a new baseline, right? 60,000 is the new 1,300, right? Or I guess 58,000 if you want to be technical, because of the 58K guys. So if we ever do, and we probably will, I see us at some point breaking out of here and going into the 6 digits. Once you break 100, $1 million's not far away. At some point, hopefully, there's fair value, and it goes sideways forever in a sense. You'd need an actual use case. You need Bitcoin to be used for something, not just speculation, and store value for that to happen. The original thesis was there's a fair value at about $1 million. It's going to take a long time to get there. It's going to get there in a certain way. And once it gets there, it should just be stable, right? Especially if it's being used in corporations, balance sheets, even sovereign nations. It's kind of the goal of Gen Z.
What's the fundamental value of Bitcoin? You can put any price on that kind of thing, depending how bullish you are. Like, you hear people saying 400K at the end of the cycle, but yet we're still at 58K. Do you think there's a reason we're trading at 58K? Do you think there's any manipulation going on at all since the ETFs? Or is this just natural price cycle going on?
Okay, yeah, so yes and no. First of all, value does not equal price. Price is a different measure. right? Value is a long-term. One of the big mistakes in not just in Bitcoin and finance in general is people trading short-term based on a long-term thesis. Even if you're 100% sure it's worth $300,000, why is it at 58? If it's only at 58, then it could go to 28. And it's still worth $300,000. The price is not equal to value. The price equals the liquidity of the buyers and sellers. If you're a long-term believer, if you really believe in something you're investing in, like real estate, you want real estate to go down because you want to buy it cheaper. Buyers like low prices, sellers like high prices. So if you really are an investor long-term of Bitcoin, you actually want the price to drop so you can buy more. And then if you find yourself saying that you want the price to go up, then you're really a short-term seller. And it's good to just understand, look at yourself and say, Bitcoin hits 120,000. What exactly am I going to do? If you see yourself with riches and selling, then you're a seller and you're more of a speculator. And you should differentiate that. And if you're a speculator, then price is important. And if you're not a speculator, then price is not important. I don't know if that answered your question.
No, that was a great answer. It's quite funny.
Oh, it's
paradoxical that the bull should be bearish and the bear should be bullish in a weird way. But maybe I should transition to this whole FOMC meeting next week. We have the potential Fed dropping rates, maybe 50 points or 25 points next week. What's your take on that as your Wall Street experience would give you?
It seems like the Fed is behind the eight ball always. Lowering rates is too little too late, right? It seems like it's not going to stop this drop in the market. Usually the first rate cut is at the beginning of the drop in the stock market. That's what it looks like. It could be we're waiting for the election. I heard the other day that rates are going to go to negative. Depending on how big the crisis is and how much liquidity gets pumped in, usually they go too far the other way and flood everything with liquidity. That will show up in Bitcoin first. So Bitcoin becomes the leading indicator of global risk appetite. That's what it seems like right now, which is interesting. Not what we expected Bitcoin to be, but what it is now. Wall Street's here. It's not even a separation anymore. Like Bitcoin is completely integrated. It's an asset. Yeah. It's a great asset to speculate in. You did mention something about order books and manipulation. If you are a trader, if you are a speculator, then how to trade and where to trade and exchanges, that's where that comes into play.
Yeah, because I've seen stories online about potential ETFs being the end of Bitcoin because the price can now be manipulated by the big ETF holders. Is there any truth in that?
Yeah. So if you're talking about this big story about silver manipulation with the futures, there could be macro manipulation with over-leveraged companies. I don't see that right now. There is a rumor, a story that this move from 15 to 35 was manipulation. At the end of the day, we're talking about Wall Street money. They do whatever they could to make money. But as far as governments or conspiracies to keep the price down, I'm not a believer in that. We're still talking longer term, and this is all bigger macro story. Regarding short-term manipulation, that goes on all the time. That's rampant everywhere, and especially in DeFi or
you see in DeFi indexes all the time with MEV bots and small DEX exchanges where you always get really bad prices. That's why I was asking about that question. I really appreciate the answer. What are your views on technical analysis? Does it have any kind of credit? Is there any kind of power?
Investors shouldn't really care about price. Investors just want the market prices, right? And how do they get the market prices? They go to a place, they go to an exchange place, and an exchange place has traders, speculators. And speculators as a group get paid for providing liquidity to the rest of the people that want to buy and sell. Once you're a price speculator, it purely is about emotion, is about others' emotions, about general. Are you able to predict what other people are going to do? That information shows up in the charts, in the price and the volume. Assuming we have deep liquid fair markets, technical analysis, not necessarily with all the moving averages and crossovers. The ability to, like I said, if the market knows everything, the market knows all, you are able to see the market and assess the reality. For example, right from Mt. Gox shut down, there was a big spread against Bitstamp. Bitstamp was trading like $300 below Mt. Gox as chaos started happening in Mt. Gox. You see that price and you say to yourself, that should be arbitraged out. And then you say to yourself, okay, what does that mean? And now the question is, can you come up with a thesis that explains it? And the thesis was that Mt. Gox is about to shut down, and the only way out is through Bitcoin. If you sell your Bitcoin and you're sitting in dollars, you try to get a wire, it's going to take too long. So there was a rush to the exits. That is how me and other people were able to get out of Mt. Gox by using price. That's an extreme case of technical analysis. Instead of having a thesis, you use the price to figure out what's happening. And that's the whole idea of trading. You could actually do this on a 5-minute by 5-minute basis. So what is price? Price is the past, right? The price tick you see doesn't exist. It happened in the past, right? Even if it's a millisecond ago, it's still the previous. Where you could buy and sell is a function of liquidity.
So if you're able to understand liquidity in the order book, would you be able to predict future prices then using that method in an accurate way?
Okay, so you're talking about the trading game. That's like a game of poker, right? Let's say 10% of the people make all the money and the other 90% lose the money. People have been day trading for many years, and there's a skill to it. The skill is predicting price, predicting flows. Let's talk about a trading pit. In theory, you could be good at figuring out the flows of funds and understanding who's the buyers, who's the sellers, and where you think the market's going. And as a group, that's where the traders get paid. They get paid because they're providing a service. They're providing a service to everyone else for liquidity. When it comes to order books, if everything in the order book was real and it was there by limit orders for people that want to buy at certain prices, that would be the case. However, what's been happening for 20 years is it's all bots. It's all high-frequency bots, latency arbitrage bots, markets. Everyone's hedging against other exchanges, and the other exchanges are hedging against other exchanges. At the end of the day, you can't really tell what the flow is just by looking at the order books. On Sidepit, we have a new type of order book that hopefully will make it a real order book with speculators instead of just mechanical arbitrage. I think that an exchange is supposed to be the place where all the liquidity comes to find price, as opposed to a place where special access, co-located bots come to find retail. Right. For example, if you were running a Bitcoin conference and you had to pay, you wouldn't go to an exchange to sell. You'd go to some private over-the-counter desk. It's all backwards. The exchange is supposed to be the place where you get the liquidity, but it no longer is. More broken in Bitcoin than it is in the stock because they have regulations and we don't. But this is all before DeFi.
Regarding trading-wise, and you want to beat the game, there's all these high-frequency trading bots in the exchanges. Are you just against all these market-making bots? Is it actually possible to win the trading game now?
It's much harder. It's no longer a positive sum. It's a negative sum. So it's much harder to win, but you still could. If you could predict price, that's the hardest part, predicting price. So the question is, if you could predict, you're going from 60 to 57 and 57 to 58 and 58 to 54, right? Calculate that and then calculate how much money you actually made off those predictions. And that's called implementation shortfall, which is a slippage. And you see, okay, I'm able to predict the market, but my executions aren't good. That's called execution risk. The smaller you are, the easier it is, right? But you have to go to third parties to do it for larger amounts. And as you get bigger, you risk really bad events happening. Everything's hunky-dory until something breaks and everyone pulls the liquidity. You got to remember that these market makers are not price speculators. They don't even have a position. They don't even care what the ticker is. They're just doing latency arbitrage and breaks. They all pull their bids. The OTC desks give you a timeout for 30 seconds. At that point, there's no more liquidity. You could think of March 2020. That's when it all breaks, and that's where exchanges are needed the most. I don't want to knock Solana. There's the fastest blockchain. When they're down, you count the TPS, all the seconds they are down, then we average it out. It's no longer that good. Exchanges look good on a daily basis, and then every once in a while, there's an event that breaks the whole thing, and there's no liquidity, either up or down. Ever since Silvergate? What was the name of the bank? There was a bank moving dollars from exchange to exchange.
Yeah, I think it was Silvergate.
When that went down, the Bitcoin price really started acting up.
Is that what you call a flash crash? And beds?
Yeah. Flash crash is funny because there's two kinds of flash crash. There's a technical flash crash. At any moment, you send an order in the market, you could trade $8,000 and instantly back to 58,000, right? As soon as that happens, everyone's, I want to buy at 8,000. I'll buy at 20. I'll buy at 30,000, right? But the fact that it happens shows that's not a market, right? That's like a mechanical break. The reason why it happens is very complicated, but it's because of the game of chicken that the market makers are playing, since they don't actually have a directional idea of what they're trading. They're all trying to not get a position they don't want, so they all cancel their orders constantly every millisecond. And a couple of times a year, some big order comes in, and all the bids are canceled, and it starts this flash. Once that happens, those big traders can't do what they were doing, so they have to run execution. They try to do limit orders, which people think that limit orders solve the problem, but actually limit orders just gives away your position, and it's, of course, it'll stop the flash crash, but then every other trade, you're going to get worse slippage. So the whole idea of a market order is you're going to get filled immediately, and that's what the market makers are the most afraid of. But at the end of the day, if you really predict the price, you want to trade with market orders. At least you used to want to trade with market orders, right? We're trying to bring it back. We want to make market orders market prices again.
So does Sidepit not have any limit orders? Is it all market orders? Right?
No, Sidepit has limit orders, for sure, but you may never get filled, right? A limit order is I know it's basic, but a limit order is more of an execution strategy. In a perfect scenario, the market price is supposed to give you a market price plus the spread, but you're paying the spread to get immediately filled. You could be a limit trader, that's fine too. If you're trying to buy a rebound or you're trying to build a position, yeah, limit orders are great. Or to catch a flash crash, limit orders are great. Market orders shouldn't be something to be afraid of. Today they are, obviously. And then, so yeah, we're trying to create so what we do is we have an auction process, a 1-second auction process that, for example, instead of it hitting $8,000 that time, and I think it was BitMEX, you do what you do in the trading pit, where people start bidding. People start bidding on how much they're willing to pay, and it ends up becoming the market price for this fat finger, let's say, right? We're not saying that we're going to stop volatility, we're going to stop big events from happening, or even massive crashes. We're just going to take away the technical flashes and leave the market-based flashes. So we're just pausing time and giving the humans time to make decisions. At the end of the day, it's a win for everyone, making the price reflect the market, the activity of speculators, rather than the activity of people that have special access or fast access, or miners that have ability to mine a block, right?
So the auction process just makes it human tradable, like you can actually have a chance at winning the game. Is that what you're trying to say?
Yeah, you can actually have a chance of being more sophisticated. If you don't have a direction on price, then you risk not being able to run your arbitrage strategies. So there's something called payment for order flow. There was a scene in the movie Dumb Money about this, where the CEO of Robinhood was asked, are you willing to give payments for order flow back to the customers? That's the whole idea. We're democratizing that order flow alpha in a sense, and we're letting anyone compete for it. And the result It could be that we're recreating the trading pits, the trading floors, where the speculators would be making the markets and creating the liquidity for the long-term holders. That's why it's a win for both sides.
I'm just getting this right. The positive sum game is that the buyer and the seller in the trade gets the best price, whereas like the current setup is the traders get the worst prices, right? Is that what
So the positive sum game is if you are a farmer, right? You're a wheat farmer, right? And you trade once a quarter, right? You go to the Chicago wheat pits. They create a service for you to de-risk the price of your wheat, right? So you don't really care what price you get, and you're not a trader at all. So you basically are paying the speculators to take your liquidity, and you're okay with the price you get. The idea is that longer term, people don't care about small prices. They just want the liquidity. They want bad prices. That's what I mean as the positive sum. The group of professional traders provide a service, and that service today is being offered by over-the-counter desks of high-frequency firms. So today, there is no positive sum game because of that reason. If large players came back to the exchanges, that creates a positive sum game. And now 95% of trades are not done by hedgers. They're done by the speculators themselves. So now you're inside the game. You have to win. It becomes like a high stakes game of predicting price. That's what I mean by positive sum. Inside the pits, everyone's getting paid. Professional traders are getting paid by the investors for liquidity.
Okay, maybe you can go into the difference between the trading pits and what's happening. You got the Chicago trading pits. From what I understand, you had two sides, you had buyers and sellers, and people shouting and screaming for prices. People got the correct price they wanted if they agreed and gave a handshake to the person. Whereas now it's just like an order book of lots of orders. Most of these orders aren't even from real people, they're just from bots. Right.
So the main difference is that there's no asynchronous communication. So everyone can see and hear everything. All the information is there. Everyone's in the same room. But the whole problem of the Byzantine generals problem, the whole problem of communication at a distance, the reason why you need the centralized place is because when you go electronic, it's a single pipe and a single order of events. And one thing happens at a time, and you lose that ability to get all the information at once and make a decision. Now, someone goes first, someone goes second, and it turns out whoever goes first wins. It took a long time to figure this out. The reason why all the bots are doing this is mostly bots now, but I don't think the problem is the bots. I think the problem is the unfair advantage, co-location, and manipulation. It actually broke the markets in various ways. We're talking 20 years already. The difference is that you didn't have the ability to get closer to some matching engine and be first. Once you're first, you get to react before anyone else. If you're not first, one of 4 or 5 winners of the high-frequency trading arms race, everyone else is a loser. And if you're trying to run sophisticated bots, you need strategies to beat them. The main strategy is order flashing. If you're not first, you have to cancel your order. You have to buy over and over nonstop. That's why you see the flashing. It turns out this entire high-frequency thing does not add anything positive to the market. It just created this game of microstructure. Then when MEV started happening, it's a new arms race that's so egregious and extreme that it just doesn't seem to be sustainable. The problem with decentralized exchange is obvious front running. If you use miners, the solution is not to use miners and not to use blockchain, make a new type of system that creates the purpose of exchange, which is price discovery. Took the craziness of the MEV searchers to bring this to light. We'll see how it looks, but we're excited about finally getting there.
Great. I'm out of questions now. Maybe nice. Someone from the audience. Yeah, I really appreciate this conversation, Jay. Given your background on Wall Street and what you're doing with Sidepit is really interesting to me as someone who's a trader. It's interesting to understand how price moves and why it moves the way it does. I'm sure you're probably quite similar, given your background.
And also what we're launching, this initial beta product, is going to be a way for you to hedge your Bitcoin risk. With Bitcoin, you could hedge the dollar price, or you could actually leverage the dollar price with Bitcoin. if someone thinks the price may drop, they could temporarily take a position, and when it does, they have more Bitcoin. In exactly the opposite way. As a group, they're going to win. Some people want to become top traders, and that's why trading is such a massive space. You actually could have positive returns. Although trading is a good thing, certain types of exchanges are not. Perpetual 100Xs and stuff like that, or what Jump Trading just came out with their binary options. Anytime someone comes up with a new product from a financial institution, they're just trying to add more complexity to the problem.
Right.
And
I imagine like those 100X exchanges, you can see your order as soon as you open up a 100X trade. So they're just going to wipe you out. Or not the exchange, but the market makers with their bots. They can just wipe you out quite easily, can't they?
The whole market knows where those capitulation points are. So it's not individuals doing it, but the market as a whole will always go to the points where people are going to be forced sellers or forced buyers, right? That will always be the place. But it's even worse than that with perpetuals. The reason why perpetuals exist in the first place is because they wanted to make the easy user experience. I call them never contracts because they never expire. A futures contract has a future price. A never contract has a never price. So if it's never going to converge into the price of Bitcoin, the perpetual could trade at $3 or $3 million tomorrow. What's stopping it from happening? So they add this crazy mechanism on top, funding rates. Perpetual futures exchange needs a price feed, needs a real price feed, and then try to match the funding rates to try to force people to go in one direction or another, or else they have to pay interest. So it turns out the purpose of exchange in the first place is price discovery. An exchange at its core that needs price in order to exist is not an exchange, and it's actually not an exchange. Perpetuals are not exchanges at all. They don't lead any markets, and they're very dangerous, and nuts that this has become the norm. We're definitely not going to do that. We're going to have a little of a learning curve, but that's going to be slower paced, less leverage, less retail, and price discovery. That's our goal.
Sounds really good. I really appreciate the way you explained perpetuals, because I've never heard it explained like that before. That there's just never contracts, and yeah, that was really interesting. Thank you for your time, Jay.
Thanks for doing this, Matt. Let's do this again, and next time we should get some people up, more questions. I don't know if anyone's... Raise your hand if you want to come up.
I think they're all listening, but I got a lot out of this. I really appreciate this conversation, learned a bit.
Thanks.
And thanks for inviting me up, and maybe do this again sometime.
Thanks for doing this.
Bye.